Tomorrow, the world is going to be on edge as everybody waits to hear from Fed Chair Jerome Powell and what the FOMC is going to be doing about interest rates. And right now, everybody wants a rate cut because they want to understand just how important this next Fed meeting is. Now, on Wall Street, you hear this all the time that the most important Fed meeting is the next one. But this one is of particular importance because right now, everybody wants a rate cut. You know, we've been hearing from President Trump since he took office that the Fed needs to cut rates. We're hearing from business owners of all sizes. We're hearing from builders. Everybody needs a cut. Even consumers are saying, look, we're under financial stress here. Everybody wants a rate cut. And yet the issue with the U.S. economy right now is nobody actually understands what's wrong with it. And so what everyone's looking for is an answer to the issue that's been going on since 2021. And my friends, back in 2021, what we started to see is the U.S. economy decelerate. Nothing has changed its trajectory. Now, the risk is if it continues, we're going to be in an all-out recession. But the problem is we're at the point where everybody now believes that it's up to the Fed. They're the ones that are holding back the economy because the issue is nobody really understands what's wrong with the economy and no one knows how to fix it. We're going to talk more about the real issue with the economy here, but even the Fed says, look, we've been keeping rates in restrictive territory. So even they've been buying into this narrative that, hey, we can cut rates here a little bit, and well, maybe that will unleash a lot of spending. Now, there's a very specific reason they want you to believe that we're in restrictive territory. It has everything to do with the stock market. Now, we'll talk more about that in a little bit, but right now, let's talk about the consensus. Everybody thinks the Fed is set up to cut 25 basis points. Now, there's a few outliers. Some people say, hey, look, we can go up to 50 basis points. Either way it goes, if we have a 25 basis point cut, look for them to say, look, every meeting after this is likely to be live and there'll be further cuts if it's needed. If we go 50, you'll hear Powell say, look, we're going to see what happens. We're going to go into a pause. And there is supportive case. If you look at this chart here, if we overlay the 2-year Treasury yield against the effective federal funds rate, what you can see is the Fed follows where the 2-year Treasury yield goes. And right now, the 2-year yield is saying very clearly we could go as much as 50 basis points. But since the Fed lags the 2-year yield, expect them to go 25 basis points and have every meeting live after that. Now, last week we mentioned there was a major issue with one of the board members, Lisa Cook. Trump was trying to get her off the board, completely unsuccessful at this time. She is a voting member. She is going to vote on policy at tomorrow's meeting. And right now she has largely followed every move Powell has made, so we can likely expect her to continue to do that. But someone else who's now on the board, Stephen Miram. Now, I want you to get this. He is a voting member, but you're going to love this because Elizabeth Warren has come out and already said, look, you're going to have to discount anything this guy votes on because he's just a puppet of President Trump. Now, I want you to get this. I don't know if you realize this, but a year ago, Elizabeth Warren was calling for a 75 basis point cut. In fact, she even wrote a letter to Fed Chair Powell, and in that letter, she cited the fact that inflation has cooled off. Well, it's right. It's done that again. In fact, we're very close to the Fed's 2% target. She cited a slowdown in the labor market. Well, we've seen that too. And on top of that, she blamed the Fed for slower job growth and holding back on the housing market. So what is her motivation right now, my friends? I want to know from you. Do you think this is just simply political? Is there something else? Weigh in the comments below. Because as we talk about this next meeting, and it's important, the real issue is, can Powell push across a 50 basis point cut if he wants it? Now, a lot of people believe this board is a consensus board, meaning they vote and whatever side has the majority is what happens. That isn't the case with the Federal Reserve. It's what the Fed chief wants is what the Fed chief gets. And that's why you see in the votes, you see people that vote for and vote against. So what we're going to see at the next meeting here is, can Powell convince everyone, if the need to go 50 basis points is what he wants, to get there? And I think it's going to be a huge challenge because there's a lot of members on there that don't want to cut rates that much. So I think the easy path here is to go 25 basis points, and then you'll see every meeting after this is going to be live. Otherwise, if we get a 50 basis point cut, look for him to say, hey, our next meeting, we're going to go on pause. We're going to see how the economy handles this 50-point cut. But right now, the bond market is very clearly saying 25 is on the table. And even if the economy continues to weaken, you can still make money trading the markets. I want you to see just how easy this is. Now, this is from our new Metre strategy. This trade went out on the 5th to all our subscribers on GDXJ. That trade now up 11.74%. And my friends, it's so easy to make money in this market. We give you the signals, we give you the risk control levels, and right now we have fully optimized our Metre strategy, and we're going to roll out some even bigger changes in the coming days. Now look, if you're trading or you've been thinking about trading, you don't want to miss out on this. Grab those links in the description below. Use a coupon code for your free 30-day trial. And stay tuned to the end of the show for more information. But when it comes to the economy, when it comes to the real issues that are facing the U.S. economy here and why people want a rate cut, well, it has everything to do with the U.S. consumer. Because right now, the global economy is slowing down. The U.S. economy has been slowing down for years. Nobody seemingly has an answer to it. Nothing so far has really worked. So again, it's coming down to this rate cut. Because as we look around the world, what do we see? Manufacturing sectors are slowing down and in a big way. In fact, the big risk that I've been talking about for a while is as backlogs get worked through, what's going to happen, there isn't going to be enough work to sustain the existing workforce, and manufacturers are going to be forced to lay off. In fact, we're already seeing that spill over into the services sector. So again, it comes down to the economy. Because the risk to the economy right now is a slowdown in hiring. We've seen that in the JOLT survey. Job openings are getting pulled. And in the manufacturing sector, again, in particular, we're seeing hours work get cut. We're seeing job losses. And what are we seeing in the services side? We're seeing hours work start to get cut. So from a labor market perspective here, everything is aligned with cutting rates. And again, this is important because the Fed policy, they usually follow inflation until you lose a labor market. Because I want you to understand, once you lose a labor market, inflation becomes transitory at best. And what we're seeing this starting to spill over into the services side of the economy, but we got some retail sales data today that might change that a little bit. But what about inflation? That's been a big factor here. In fact, we've heard Powell push back on rate cuts because he's saying, look, I'm worried about inflation. In fact, we just got import prices coming into the U.S., and as of last month, they came in at 0.0%. So what you see, my friends, is all this fear that we're going to see tariff-induced inflation. It's not showing up in the data. What we're finding out is manufacturers and businesses, everybody's trying to absorb this. And if you look at this from the input side, what you're seeing is deflation coming out of China. Again, inflation expectations are going to plunge here. But let's talk about this retail sales report because it came in at 0.61%. If you take autos out, that number was up 0.7%, and that is huge because what we're seeing here, despite the fact that U.S. consumers are rather pessimistic about the economy, as we continue to see in the surveys, they really haven't cut back on their spending. They're still out spending in a big way. Now, we could argue this has something to do with the back-to-school season because we've seen a big increase in online retailers, clothing stores, and sporting goods stores. So maybe this is just a one-off report that will change as we get into the school season, but maybe it's a trend. Because when you adjust for inflation, the year-over-year rate of change is still rising at 1.8%. Now, historically, that's fairly weak, and the trend isn't really that strong. But so far, despite the pessimism from U.S. consumers who continue to say that they're worried about losing their job, they don't seem to be worried about spending. Now, again, this could be all due to front-running the tariffs here, and it could be that they're putting a lot of this on their credit cards, but the bottom line is we're not seeing it show up in retail sales. But will this keep retailers from laying off? Well, that's the real issue, is because inventory levels are rising at a much faster clip. That's the problem here. But if you want to look at some good news, well, restaurant and bar sales, they were up 0.7%. So as we look back over the summer, we could see that maybe it was trade uncertainty because consumer spending really didn't stop here. And when people are feeling optimistic, they go out to eat and they spend a lot of money. And that's what the latest report told us. The problem going forward is, does the U.S. consumer have the staying power to continue to spend? Because there's another part of the data that really will change your entire perspective on that report. And that is half of all retail sales are being driven by the top 10%, the wealthiest 10% of U.S. consumers. So you think about the actual state of the U.S. economy here, the lower income people, man, they have been behind and they're still behind, and there's no signs they're going to catch up. In fact, we're seeing a slowdown in the economy even impact the middle class, and at some levels, we're seeing higher income Americans fall behind in their credit card and car payments. So as we look at this economy, you can really see there's two sides of it. The top 10% benefiting by the equity market and continuing to spend and spend big. The risk is, of course, if stocks were to come down, that spending is going to dry up, and then you have everybody else. The problem is everybody else, well, they're the ones that are the real economy, and unless you see the stock market continue to power higher, we'll look for a change in the spending of the wealthiest. And speaking of the stock market, well, that is the risk that we're facing right now. And I've been worrying about this for a while, that a Fed rate cut isn't bullish. Now, it's going to be perceived as bullish. You're going to see stocks likely go up over the next month or two. But I want you to keep in mind, historically, when you look at the 3-month window after a rate cut, well, what happens is stock prices tend to follow. Now, I know you might be saying, well, wait a minute, Steve, you got this wrong. The Fed cut 50 basis points and stocks rallied. And how about going into the pandemic? Well, stocks rallied then too. But keep in mind, with the pandemic, people were getting stimulus money and pouring it into the stock market. So when you think about rate cuts, if you have a rate cut due to falling inflation, but it's still a relatively strong economy, that's considered bullish. But if the Fed is cutting due to labor market weakness, and that's why the messaging tomorrow from Fed Chair Powell will be very, very important. If he cites the labor market, watch out, put a clock on this. It means you have less than 3 months. But look for the equity market here to power higher, and look for Powell to get a whole lot of flack for cutting rates at the peak. But keep in mind, when does the Fed always cut rates? When stocks are at their peak. So that's not really the issue here, but the underlying issue, and we've been talking about this on the Sunday show, is market breadth. We know that's weakening. Watch out for that, because that is a major red flag here, that the stock market is being led by a small number of companies, which means more money is getting concentrated into them. If indeed we are on the cusp of a bear market, as this next rate cut could suggest, watch out. As everybody tries to get out, well, it's going to be something called a fire sale. But why do you see the stock market get bullisher? Well, it's because everybody believes it's bullish. People are going to say, and you're going to hear this in the news, that the Fed is injecting liquidity into the economy. And you're going to hear this correlation between tech stocks and rate cuts, that rate cuts are super bullish for tech companies. In fact, they're so bullish for tech companies that last week, hedge funds bought a record number of tech stocks. Now, of course, if you look at the price chart, it didn't go up a whole that much, but nevertheless, people buy because people believe in something. And right now, people believe that rate cuts are bullish for equity prices. Look for them to pile in. But the underlying issue here, and I want to be very clear about this, if the labor market continues to weaken, well, then you've got a problem. And that's why we're going to turn to the bond market here, because what it's signaling is the economy is going to continue to weaken. And right now, as we look at yields, particularly on the 2-year, what do you see? It's telling us that as yields go down, that growth and inflation expectations are falling. And what it's very clearly saying is, look, the Fed's behind the curve. So if you see the Fed cut rates tomorrow and continue to cut, and 2-year yields continue to fall, it is the biggest red flag for the equity market. But again, expect equity prices to power higher here. But again, the risk is, if we see the bond market continue to signal that the Fed needs to cut, it's a massive warning sign that rate cuts aren't enough to change the trajectory of the economy, and the Fed is going to have to get aggressive at some point. What this indicates is we're headed into a recession, and at this point, again, going back all the way to 2021, it's telling us nothing has worked and nothing is working. But what is the real issue in the economy? One that seemingly nobody seems to really understand? Well, let's go back to 2021. And what happened at that time? You saw inventories start to go positive. Now, they were being drawn down before that, but all of a sudden, the year-over-year rate of change in inventories, it shot up and accelerated higher. And ever since 2021, what have we seen? Inventories have been on the positive end of the curve. You've seen inventories being built at the manufacturing, wholesale, and retail level. But what was the same thing that happened in 2021? We've talked about this a lot on the show. hours worked. And what happened? They started tumbling. In fact, and as a result of that, what did we see in retail sales? We saw them decline right alongside that. And that's what's interesting about this recent retail sales report. Of course, we know it's powered by the wealthiest 10%. The problem is, can they hold this market up? Can they keep the economy humming so everyone can play catch up? I'm not sure that they can. Because the issue we're facing right now is this massive inventory overhang, and it's affecting everybody across the board. In fact, right now we're hearing from home builders that their sentiment is at the lowest level in years. And there's a good reason for that, because we've talked about how inventory levels are at their highest level since the financial crisis. So what this is all telling us is, from a builder perspective, they think that lower rates are going to help them because they can refi their existing loans on their unsold property. They also think those rate cuts are going to bring in the foot traffic, and that people are just a quarter or a half a point cut away from a brand new home. The problem is they're not. And see, this is what everybody doesn't understand. It is about the jobs market. And what are we hearing in the surveys? That it's getting worse. And while consumers are still spending, which is a big question of when that's going to dry up, the other issue is consumers can't afford these new homes. And the evidence is clear, because what have we been seeing in hours worked? It's been fairly flat for over a year. At the same time, inflation outpacing that. And what are we hearing from builders? Well, they're lowering prices to try to get buyers in. In fact, 39% of builders cut prices, and 65% of them used incentives. And this is something you're going to see all across the retail space. As inventories continue to build up and consumers do not spend at a pace to draw it down, what you're going to find out is retailers, wholesalers, everybody's going to have incentives, because they need to get rid of this old inventory before it goes bad. So again, as we look back, to the economy, and we ask the question here, are rate cuts going to fix this issue that started all the way back in 2021? And it's hard to argue that they are, because the Fed's already cut 50 basis points, and what happened? Well, other than the stock market going up, the economy's continued to decelerate. So if you think about this from a low-income consumer's perspective, is a rate cut going to change anything for them? Well, it's not. What about for the middle class? Is it going to change anything? Not really. How about higher income? Well, yes, they can borrow on margin at a low rate and buy more stocks. Because if you really understand what's going on here, is we don't have an answer for the problem. And that's why everybody's so fixated on the Fed right now, because they need the consumer here in the U.S. to come out and spend in a big way. They need us to draw down these inventories, to turn the manufacturing sector in the whole world back online and start producing again. Because if this doesn't happen, my friends, if these inventories don't get worked down, the layoffs we've seen so far are just the beginning of what's to come. Because what you have to see in the global economy is production drop to the level of demand. But right now, from the rest of the world's perspective, if this doesn't work, watch out. We're all headed into global recession. When it comes to trading, we are changing the game, and I want to show you what we're doing differently, because right now I have optimized all my strategies on a per security basis. Now, a lot of other people say, look, one trading strategy fits all, or I'll use a combination of several strategies. No more for one low price. One strategy changes everything. Let me show you the results here. This is a backtest on SPY that I ran, and this is a custom backtest engine that I wrote for real world trading. Here's what you can see: a 66% win rate, and that is staggering. 69 trades over a 3-year period. Total return beating buy and hold with a max drawdown of just over 7%. Now, how does this compare to a very popular strategy? You probably already heard of it. It's called the Bravo 9. Well, look at this. Half the number of trades. Look at that win rate, only 51%. Total return falling far below a buy and hold strategy, and you get the same drawdown. Now, again, my friends, we're changing the way people trade, and you can get in on this. Now, how do you do it? Well, I have 2 reports. One of them is called CTA Timer Pro. We trade against the machines. Another one is called Momentum Timer Pro, and that we trade momentum indicators. Now, either report for right now includes our MetaStrategy trades at no additional charge. Now, all you have to do is pick one of them, both of them, whatever you'd like to do, and you get the daily report. And you get all the tradable signals from that report, plus the new optimized MetaStrategy trades. You get my opinion on the best trades. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update. And the best part is you get a free 30-day trial. That's right, you don't have to put a dime out to try our reports. All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.